Hello and welcome to Chapter 3, Preparing Your Taxes. I'm going to start off by saying you should always go to a certified public accountant to do your taxes and take your certified public accountant's recommendations. This is an overview of things to be thinking about, but tax codes change every year, so you should always go to a CPA to do your taxes and to prepare any financial plans before you take any action. Okay? So the learning goals in this chapter discuss the basic principles of income taxes and determine your filing status. Describe the sources of gross income and adjustments to income. Differentiate between standard and itemized deductions and exemptions, and calculate taxable income. Prepare a basic tax return using appropriate tax forms and rate schedules. Explain who needs to pay estimated taxes, when to file or amend your return, and how to handle an audit. And audits are horrible. I hope you never have one. Know where to get help with your taxes and how software can make tax return preparation easier. And then implement an effective tax planning strategy. Here is how it will affect me. In red, this chapter helps you understand how your income tax is computed and how you can maximize your after-tax income. And there's some facts and fantasies. Impact of income tax. Typical American family pays more than 1/3 of its gross income in taxes, including federal income tax, Social Security, and Medicare tax. Excuse me. State income tax, property tax, and sales tax. One thing you can do is move to a state that doesn't have state income tax, and that will help you lower your tax rate. Goal is to legally minimize taxes. About half of taxpayers pay no income tax, but all pay Social Security and Medicare tax. Total rate of 7.65% of wages is paid by the employee, and then about the same is paid by the employer. Taxpayers with income over $250,000 filed 2.4% of tax returns, but paid 48.9% of the income tax. Okay. Tax computation. Tax equals tax rate times tax base. Name of tax indicates the tax base. An example is property tax has a value of the property as a tax base. Sales tax base is sales, etc. Lower tax by lowering tax rate or lower tax base. So if you want to pay less property tax, you buy a cheaper house. That lowers it. Another way of doing it is to buy something that has an agricultural exemption. You could start a nonprofit business and live in just part of the structure, and the nonprofit business is in the rest of the structure. So depending on which state you're in, the nonprofit part of the business, part of the building may not pay any tax. Okay? That's one reason why when for example, a church buys property and builds a church, the local and county and state lose money because it no longer has to pay the property tax. Lower tax rate by nature of income, capital gains, and dividend taxes at maximum of 20%. So if you're at the highest tax bracket of 37% and you change how you get your income to make it a capital gains, now all of a sudden that 37% tax rate falls to 20% on the money gained by having it like that. And I need to stop for just a second and I'll be right back. Okay, tax rates, single taxpayer. Okay, so in 2018, if you made $9,525 or less, you were taxed at 10%. And in 2019, it was changed to 9,700 or less was 10%. So each year you can go down and see that the income was increased to get the same tax rate. And then it went from 500 to 510,000 for the 37%. Okay, so we went from 2% there, 3%. Then this is the largest one, which would, oh no, I'm sorry, second largest. So that was 8%. Then this is the largest, 10%, and then 2%. So going from $39,475 to $39,476, your tax rate increased 10%. Okay? So it really doesn't make any sense to make $1 more if you're going to pay 10% more in taxes. So that might be something that you're considering when it's time to look for a job. That one job may pay $84,000, the next job pay $85,000. Well, that's only a 2% difference in taxes, so that really doesn't make much of a difference. However, if one job pays $38,500 and the next job pays $40,000, that's an enormous difference in taxes. Okay, so that extra $1,500 may cost you 10% or $4,000 in taxes, which means it probably wasn't worth it. Okay, so that might be something to consider. So tax rates, federal income tax referred to as a progressive tax because as you make more, you pay more percent of your taxes. The average tax rate equals the total tax divided by the taxable income. The marginal tax rate is the tax on the last or next dollar of taxable income. The marginal tax rate is what I was trying to say about determining which job and how much money you're going to make. Take taxes into consideration. Filing status, you can be single and unmarried, married filing jointly, married filing separately, head of household, which means you have a dependent, and then surviving spouse. For 2 years after the death of a spouse, the surviving spouse may use the joint rate if they have a dependent child living with them. Okay. Also, fun fact, if you are married filing jointly and you get divorced, you are responsible if something happens and they now owe taxes for that year. So something that could happen is after you get divorced, they decide to declare bankruptcy and do not pay many of the deductions that were taken for the last joint paid filing year. So let's say you got divorced this year, but you had already paid your taxes as a joint, and then your now ex-spouse declares bankruptcy and does not pay the bills that were used as deductions on that tax. Well, the IRS says that that's now income since you used those as deductions, but you didn't pay them. Or if you borrowed a great deal of money and then you wrote it off in a bankruptcy, the IRS can come back and say, well, even though that was a loan, you never paid it, and so now it's income, and you owe taxes on that income. If you filed married filing jointly, and that affected that year, both parties are responsible for the taxes on that income, even though only one party declared bankruptcy and created the tax liability. So, not that I would say anyone wants to plan for a divorce, but if you get to the point where divorce may be something that you are going to do, you may want to file married filing separately, so that you are not obligated to anything they do that creates a tax liability. Okay? Learned that the hard way. So I'm just trying to share my experience so that you don't have to do it. Okay, so take-home pay is the taxpayer's gross pay reduced by income tax withholding, Social Security, Medicare taxes, and cost of benefits such as health and life insurance, the premiums that you're paying through your paycheck, retirement contributions, all those deductions that come out of your pay. What you have left over is called your take-home pay. Income tax withholding is based upon your income and number of withholding allowances. So, if you have just yourself, then on your withholdings, you could just put one. If you have yourself and 3 children, then you could put four plus head of household, so that would be five. The more withholdings that you put, the fewer taxes that will be taken out of each paycheck. However, it also means that when you file a tax return, then you won't get much money back, or if you had additional income, you may actually owe money instead of getting a tax refund. So it depends on whether you want a tax refund or if you want your money from each paycheck and not have the government hold your money. Remember, if something were to happen and you were to owe the government money for whatever reason, and you have a tax return, a tax refund, they can keep that. Whereas if you don't have a tax refund, you actually owe them money, then obviously they can't keep your money. Okay? Calculating your taxable income and total tax liability. Here's a model that you can use to actually do that. Again, this is just to give you an idea of how things are done. You should always see a certified public accountant to actually do a complicated tax return and figure all this out so that you're using accurate numbers based on the current law, because tax laws change every year. Okay. Capital gains and losses and dividends. Capital gains, long-term gained from the sale of property held for more than 12 months. It also includes stocks. If you buy a stock and hold it for more than 12 months, then it's taxed on the 20% versus your individual tax rate, whichever it could be up to 37%. Short term is held less than 12 months, and that's normally taxed at your normal tax rate. So if your normal tax rate is 37%, then you'll have to pay 37% taxes on your profits instead of the 20% gain. Long-term gains have alternative reduced tax rates, which is what I just explained. Okay, and we're almost out of time. So if we come down here, okay. Tax credits, reduction in tax value is the amount of credit. Deductions, reduced taxable income. You have the child tax credit of $2,000. Qualifying dependent, not a qualifying child is eligible for $500. You have education credits, residential energy credit, child and dependent care, and earning income credit. Again, these are all subject, or at least most of them are subject to your earnings. So if you earn above the amount that's allowed, then most of these will not, or some of these will not qualify. So in other words, you can't take them if you make too much money. Okay. Pay as you go withholding tax. Employers required to withhold income tax from employee's salary before paying an employee. Obviously, you see that on your pay stub. Okay. There's what a 1040 looks like, and there's the next. That's additional income and adjustments to income. So if you made additional income, extensions to file. It's an extension to file, but you still have to pay the taxes. So if you don't have your taxes done on time, you can file for an extension, but you have to send in what you think you're going to owe. Otherwise, you're subject to penalties and fines and everything else. Okay? So here's an overview of taxes. I hope it was enjoyable, and I'll see you on the next chapter.